Future Design Podcast.
I understand it's a new technology, so there's always vulnerabilities, in every corner that you turn. But as we try to reduce costs, reduce human interventions, make the technology a lot more complicated than it was before, and then you get hacked and all these things happen. Do you think it's like the blockchain is like the right solution for really, achieving all these things? Lower friction, lower transaction fees, much higher security, but then you still are prone to attacks, like crazy.
Well, I mean, let's face it. There's a lot of attacks out there. Have nothing to do with blockchain, right?
Yeah,
I mean,
sure.
Right now, my daughter's turning 18, and I got this notification from one of these LifeLock companies that I have for free, and that reason for that is when I was working back in the U.S., several years ago, I had a top secret security clearance with the Office of Personnel Management. I think this was back in 2006 or something like that, and there was a massive hack. Okay, and my personal information was taken. All right, and so the U.S. government, was obliged to give me monitoring services for identity. Okay. Yeah. And then of course the Equifax hack, and then the Facebook hack. I mean,
Marriott,
like all my stuff is out there, right? So, so I'm not sure it's a whole lot better than all the crypto hacks.
The Homeland Security has everything.
Yeah. So I do think that the security thing is germane to all these different domains, if you will. It's just that how do you handle it? It's slightly different. So, but you mentioned the stock exchanges. I think every single stock exchange is doing their own digital assets business. Okay, usually somewhat like an innovation project or whatever, but full on. I can tell you these things are happening. And MAS just came out with, essentially we're going to rewrite the Securities and Futures Act here to allow crypto derivatives trading, and they would only allow that with the the regulated exchanges like SGX here in Singapore, right? So you're going to see traditional exchanges really getting into the space, and they're going to bring pretty robust solutions.
So do you think like SGX is going to list Bitcoin, not the derivatives, but like spot Bitcoin onto their exchange? Then it'll be like all over for like other crypto exchanges, right? I mean, it's like super regulated. Barely been hacked. I mean, very reliable. What do you think? It can happen, right? I mean, if it's a big enough market, they would do it.
Well, I think that would come down to whether or not MAS is going to allow it or not. Fundamentally, okay. So right now, I mean, if you read sort of what they put out there, there's a concern that even the accredited investors really are sort of like out of their league when it comes to this sort of thing.
Judging from the volatility and everything. I mean, whether you have a CFA or not, I mean, you can't really. There's no instrument to like hedge against it. Correct. I mean, you have the futures and the spots, and maybe you have options, but I mean, compared to the traditional equity world or bond world, I mean, a hell of a lot of less hedging tools for it, right?
Yeah, that kind of brings you back to then what are the major use cases? I mean, right now we see so margin speculation, I think, is like a big use case, right?
Well, I mean, when I first, kind of read about Bitcoin and all these things, I never thought about it as a tool for speculation. I thought it was, to spend or even, remit money across borders and stuff like that. And it wasn't really about speculation. And I think the moment that any crypto goes on an exchange, then it loses its function as a medium of exchange in a way.
Yeah.
But, you could counter me and say, okay, what about FX then, right? Like, USD, SGD, whatever it is, it's always on exchange. It is a slightly volatile. You can do 100x, leverage on it if you want to. I mean, there's a lot of speculation going on there. But it's just a liquidity issue, right? If there's enough liquidity, then, the volatility kind of comes down a little bit. I think there's not enough liquidity in crypto to let the volatility come down.
Yeah, it seems like until you get into the derivative space, maybe equities, you're not going to really get that either. It's just going to be somewhat limited.
Yeah, I mean, if you look at the 2017 when at the end towards November and December when Bitcoin shot up like crazy, there's a lot of people put reasons why Bitcoin tanked from like almost $20,000 to $10,000. But I do think definitely that futures did a huge impact on it. Right?
I think so too. Yeah, especially selling short.
Yeah, that's what you do, right?
Yeah, exactly.
Yeah. So because the timing was like exact.
Yeah, it
right.
was. Yeah.
So if people kind of read the financial news and knew if the futures were coming, but the thing is that helped the crazy volatility a little bit to an extent to come down, right? And it wasn't like a one-way street anymore. I mean, poor thing for the people who got long $15,000 and lost it all afterwards. But that's how the financial market works, right? I mean, you come with all these hedging tools, and then the volatility comes down. But I think right now we're just having not we, but the crypto market is having a the liquidity crunch at the moment.
I would agree with that. Yeah.
So to me, it's like so then how do you get more retail people back into it? And one thing is, like, of course, you want to be able to invest in a safe market, right? And then I think it goes back to like, okay, then how do you prevent retail investors not from volatility of prices, but their Bitcoins and ETH and that all those things get hacked, right? I think that's what's most important.
Well, I think for sure from an optics perspective, like that's what people think about, right? But where do we see a lot of action right now? It's on the God forbid, the permission blockchain side of things, right? Where you have tokenized stocks and bonds that represent the real ones. HSBC just recently, I think just this week, mentioned that they're moving $40 million worth of basically paper-based tracking onto the blockchain. You have like tokenized REITs out there where I thought that's a pretty interesting business model. Just as an example, as the BTG Pactual did this, where you have an issuer and let's say an investor is able to buy into the fund through the issuer using a stable like Gemini stablecoin, for example. And then from there, the issuer sends all this money over to the bank. The bank will buy distressed inventory like real estate and hire a property manager. And that property manager will just go ahead and manage the portfolio. And as things are bought and sold, the proceeds go back ultimately to the issuer, who then can reinvest or pay out in dividends or so back to the investor. And most of that, quite frankly, is just business as usual. But
I mean, that's kind of like more automation of the traditional processing of securities.
But right? I think that's where the growth is going to be, because people understand that there are regulations around it. But think about it. If you were an institutional investor, because we're not even anywhere near retail investors for this sort of thing, right? And you want to spread your investments around. If someone would say, hey, look, you can buy into a real estate fund for as little as $500 with very low fees, okay, in a foreign country, otherwise you'd have no access to, right? You might want to do it. You're like, okay, wait a minute, that's $500. I could do a little bit here. I could go ahead and do some over there. I can kind of spread that out a little bit, right?
Sure.
And on the flip side, if you are that bank, if you will, basically managing this REIT and through the issuer, you now have much bigger reach.
Yeah.
And because you're dealing, with a tokenized solution, the cost structure is down, right? So you can actually offer at like a $500 clip. So, to me, that's like, yeah, that kind of makes sense, right? So you're sort of blending this tokenization thing with traditional BAU, business as usual types of tokens.
These private REITs and funds have been around for as long as any financial product out there. It's just the outreach was not possible. And I thought from the introduction of internet and having web pages and being able to do KYC online, that could have gone more global. You know, you don't really need blockchain to actually make that happen, right? So, you know, what to me, you know, when I do speak to like, you know, banks, securities firms, and I do have to like prep myself to think about how is this like so much better than before? Because they could have done that too, right? But to me, it's like probably the blockchain guys kind of figured it out, you know, than the traditional bankers, because they didn't think about this thing, right? Because when I get asked like, how's this different? We could, you know, you could do it on the internet normally, and we have all these, you know, automation processes anyway. But then I think you haven't done it, you know. That's kind of what I think. I mean, I don't think any parts of like blockchain that I can think of it actually allowed any fractionalization of assets, right? Because you could have done that with anything.
Yeah, and I agree with you. I don't think fractionalization, I think that's a pipe dream. I mean, people just talk about this, secondary liquidity, secondary markets, blah, blah, blah.
Yeah.
But I don't really see that actually driving anything. You know, again, it's more about, can I take out the cumbersome complexity, the burdensome tracking compliance? Can I drive down the cost overall of the end-to-end transaction? Can I remove a lot of sort of middle men processing, if you will, so that it's a lot smoother and a better end user experience, if you will, and to deliver it faster. To me, that's kind of like what the meat and potatoes of blockchain really does provide. And so if you can come up with a use case that leverages on that, then more than likely you can do something that will make money, other than, you know, obviously the speculation use and the hedging use cases will always be there, right? But it's more about, okay, how can I really monetize this stuff, you know? And then you sort of makes you think about these DeFi platforms like Dharma and Compound, to name a few, right? So, you know, these are smart contract based approaches just for lending. Okay. So, you know, you're a debtor, you need some funds, maybe you want some funds to do some margin trading or whatever. You know, you can submit your debt order to an underwriter kind of smart contract, and it will sign a risk rating and look at the terms, and then ship it over to, I guess it's called the relayer in some of the Dharma parlance, and which is basically nothing more than an order book, a bulletin board of different loans. And then if you're a creditor, right, you can go shopping and say, okay, I'm going to go for that one, that one, that one, and fund them. Okay, you get your debt tokens, and then you send your funds across to the debtor, pay a few fees, what have you, to the smart contracts, and everything's all good to go. So it's, and here you know you could say, okay, I can take an investment. I can make, as a creditor, I can make 2% on interest, or go into these DeFi platforms and make, you know, 8 to 12%, right? And you know, people are doing that. I mean, the volumes, of course, are very small in the big picture, right? But it's happening. And so you do have again the simplicity, the low costs of these DeFi platforms that, in fact, you know, from a lending perspective, make it easier. And if you're a bank, it's an easy way to get involved as well, because you can become a creditor, you can, you know, become part of the underwriting and so forth. But actually, you know, kind of getting back to the beginning of this conversation, it just made me think of something, and that is, you know, a lot of these DeFi platforms have distributed, decentralized administration.
They do, yeah.
You know, and a lot of times these administrators, they have a lot of power. Maybe they're like beneficial or whatever, you know, like they're nice guys. But reality is that they get to set, you know, what assets are going to be loaned, what's the interest rate, and what's the collateral.
They could set the policies, right?
They could set them, and then, but more importantly, I think, is that they could censor transactions because they have access to the price feeds, and well, potentially they could even steal assets for that matter, right? So it's again,
not that decentralized.
It's not that, and then of course from an external perspective, you have like the Bancor hacks where you had bugs, right? Or maybe they weren't bugs. But the bottom line is these smart contracts themselves also have attack vectors, and so it's not like just because there's a smart contract everything is hunky dory. You know, you still have attack vectors that you have to think about, right? And you know, from our perspective, at IBM, as we really big into this whole idea of bespoke orchestrated workflows that are tailored specifically for the end user, we also are all about containing the damage. So isolation technologies are really important, right? So if these smart contracts are running, you know, in a cloud somewhere, and you know, there's a bug, if you will, how much damage can that actually do? Well, you want to put a box around that thing, right, and make sure that in fact it's limited. Yep. And that's, you know, some of the things that we're actually able to
There are
do
auditing
as well.
services as well, right? To look, you know, like, you know, look through the smart contract to make sure that it actually works
Yeah.
It's
So
non-compatible,
yeah, I
so-
mentioned that. So we use this technology called secure service container technology, and if a company, set of developers, they want to deploy, say, wallets or policies or whatever, databases, any kind of application, they would just simply, say they deploy their software code, source code into Git, right? And then we would, or I should say, not we, the service would pull from Git, build the image inside of a secure service container environment. It would sign it, create a manifest, and then you would yes, go to a third party who could do a software attestation against the manifest to say, hey, did this source code actually used to build this image? Hey, it's signed, it's in this sort of protected enclave, so nobody can change that image or replace it with another one. And of course, the auditors have their own policy. Maybe they do pen testing, maybe they do some kind of other checks and balances, what have you. When they all sign off, then the service would in fact deploy that image, let's say from Docker Content Trust, a trusted repository, into a production runtime environment that is completely encrypted, and there's no way no command line, can't type anything kind of thing, right? So yeah, so using those kinds of technologies for launching smart contracts, for managing your wallets, for deploying your databases, Binance could have used something like that when they had their KYC break, right?
Yeah.
I mean, breach, right? Little stuff like that, you want to be able to protect from insiders. And so, that's the kind of stuff that we think at IBM would be helpful to this industry, and we are in fact delivering it.
Yeah.
Yeah.
Yeah, that'd be cool. I mean, I think there's been, always constant development in, you go back to the permission-based blockchain. So now, blockchain's becoming, less about startups. Well, I mean, still, there are startups in that space, but, enterprise interest in blockchain has becoming bigger and bigger over the years. I mean, I think in 2017, I hardly heard many, big enterprises really looking into blockchain. But now if I go to like blockchain conferences, I would pretty much say maybe half, even more, are people in suits. They're from banks, insurance companies, and they're trying to look at blockchain as a solution. So in order to make these digital assets that they actually deal with on an everyday basis, the security is so much more important. And moreover, because it's permission based, they're private blockchains. They're no 10,000 nodes like
That's
Bitcoin
exactly right.
all over the world.
Yeah, that's right.
The companies have their own control system to deploy nodes wherever they want, and there's like a weak factor in that as well, right? When I always tell enterprises, yes, you could do private blockchains if you want, you can do permission based, but security level is going to be a lot lower than your traditional like public blockchain. So how are you going to implement your own policies around that if you don't really understand this technology to begin with, right?
Yeah, absolutely. So I mean, just take like Hyperledger Fabric, which is one of the big ones.
IBM.
We don't own Hyperledger. That's an open source project. But just Corda, Quorum, some of the bigger ones, right? They all, at the end of the day, look, I'll just pick on Hyperledger Fabric if I can, right? So you have the ledgers, you have the smart contracts, you have the world state, right? You have all these different, you have the order, you have all these different components, and if this stuff is just running, it's on some unprotected servers on a cloud, right? I mean, at the end of the day, you could in fact, insert a malicious transaction, and if you're using channels and other things, it's possible for that transaction then to be pushed out to all the other permission nodes, right? So it's all about the weakest link. Even if you were using some sort of encryption technology around the smart contract, as long as you had control of that node, okay, you have control of the operating system, you have control of the memory, you have control of the applications, the databases. You could take that smart contract and you could do a rollback attack, which means that something like this. So I could test what goes in, see what comes out. Instead of what comes out being ultimately written to the ledger, I reset the smart contract because I control it, and I try with another input, ultimately to subvert it, right?
Yeah.
And only when I'm ready will the result, go back and ultimately get processed by all the committing, nodes. So it absolutely, and people don't really think about this, right? But and these permission blockchains are highly dependent upon the infrastructure that they run on, because you it's all about access controls and inserting malware and permissions and I mean all this stuff, right? So there's quite a bit of risk. To your point, right? Like Bitcoin has 10,000 nodes. It's going to be hard to beat that, right? But the average permission blockchain has got maybe 6 to 10, possibly, even if it's a big one. And what's interesting is that a lot of these permission chains are becoming business entities onto themselves. Yeah. Like at least with IBM, we've got TradeLens, WeTrade, Food Trust, some others. R3 with their Corda platform, they have Voltron and Marco Polo and others. And so if you're a bank or a cement company, and you want to do a letter of guarantee, you got to figure out, well, which consortia do I want to use? Yeah. Maybe I have to do both or 3 or 4 or whatever, right? And I've got to run nodes, for all of those, right? Yeah. And so I've got to secure all of those, right? And so what I'm concerned about is that, as these start to become more and more commonplace, it's actually the security side of things is what, is really going to be the big issue, because you're going to have nodes that are not really well protected out there, and they are going to undermine a lot of these big consortias as well as a lot of the permission chains themselves. Yeah. So, like you said, it's not a ton out there, so you're not seeing a whole lot, but as they become more and more prevalent, I think they will. And I do think they're going to become more and more prevalent because, again, permission blockchains, I think, are very much the future. I mean, you don't have to look any further than, a lot of the central bank digital currencies, especially, DCEP, in China, right? These are centralized. If anybody thinks these are decentralized, they're completely wrong. No way. So, and I don't think they're going away. Like, sovereign nations.
Oh, cat's out of the box, right?
Sovereign nations want control of their currencies, whether digital or not, right? Yeah. So I don't think you're going to get a situation where a decentralized chain is actually going to win out.
It's almost scary that how Bitcoin came out and it was supposed to be about decentralization, but actually it could go in a completely opposite spectrum to becoming completely centralized, dream tool of totalitarianism, right?
That's scary. Let's hope not. Yeah. I mean, although the Fed, Jerome Powell just said overnight that in response to the DCEP in China, digital RMB, that they are looking at this for the digital dollar. And in fact, 2020 will probably bring some plans that are more concrete than just talk. So there's a real concern in the U.S. that Chinese can actually really win out here, at least make a lot of influence, and the U.S. depends pretty heavily on the dollar around the world as an instrument of power and foreign policy beyond just simply being a currency, right? So there's an interest in making sure that doesn't go away. Certainly Libra is not going to help, right? So I guess we kind of got off the topic of central bank digital currency, but maybe that's another use case that's actually going to happen, right? Yeah. So you have the permission chains, the centralized, unfortunately, the centralized blockchains, and then of course on the decentralized side, a lot of the lending and the margin trading speculation. I mean, this is where it seems like a lot of this stuff is happening. And I dare say for 2020, we can expect a lot more of that.
Yeah. I mean, definitely for DeFi, decentralized finance. I mean, it definitely works. Maybe in developed worlds, where there's general trust of the financial institutions and all that. It's. I was kind of like, maybe it works, maybe it doesn't work, but definitely for developing countries where there is sort of a distrust for the financial institution, unbanked, underbanked, all that, this DeFi thing can work. But the thing is, the concept itself is like too complicated. The background technology and how to understand that. You need a certain level of intelligence to kind of understand. It's not like, oh, I'm going to have a bank account and get financial services from the bank, right? So, that part needs to, like, personally, I think it needs to, from their side, the company side or the DAO, needs to explain a lot more, not in the kind of cyber kind of minded space, but, for the general retail, retail consumer level.
Yeah, I think so. I agree. I mean, it's a great opportunity for people to really branch out their investment strategies, and to take advantage of these autonomous services. But I think for the main bulk of the public out there, it's a ways off, right? They're gonna go with what they know.
Totally.
You know, it's about trust ultimately. Do you trust these newfangled smart contracts, and then you hear about hacks and so forth? I don't think so.
And lastly, I wanted to ask you about like quantum computers.
Okay.
And encryption and because they say quantum computing could be like the killer app for blockchain, right? I mean, what is your view on it? Because I don't really know much about this, to be honest.
Well, I'm not a quantum expert either, of course. I mean, IBM is pretty deep into this, I will say. And we have been working on post-quantum resistant lattice curves, and those in fact have been shortlisted. 2 out of the 7 or so by NIST. So we do believe that these curves are on their way. And why does that matter? I mean, well, back in 2015, they were saying that by 2030, there's a 50% chance that elliptical curves, RSA curves, that which is used today by crypto, will basically go away. I mean, they just completely obliterated by quantum. And, that was supposed to take the age of the universe to do that, and now it'll just take a few days, right? And of course, when you talk to the experts in the field, guess what they think is going to happen? Quantum technologies are going to go after the whale Bitcoin wallets.
Really?
Okay.
Wow.
They're coming. They're going first.
Yeah.
You know what I mean? And it's not going to be. It's not going to be obviously mad scientists that are doing this. It's going to be criminal organizations, right? Using rented equipment. Hopefully not the IBM quantum cloud to do that. But there is a concern, right? I mean, anybody who's really, again, into the whole quantum thing will kind of say, you're crazy. It's not going to happen for a long, long time. But I don't know. It seems like it's happening a lot faster. I mean, you have Google saying they've achieved quantum supremacy already, although what does that really mean, honestly? I think that it's something to keep your eye on. And at the same time, though, I see Bitcoin Core, responding. I see them over time improving the cryptography behind Bitcoin to sort of keep pace, if you will. So, in the end of the day, I don't think it's as big a threat as people make it out to be. I mean, and if anybody's interested, we have Kyber and dilithium here at IBM, and our hardware's post-quantum resistant already. So just buy that.
Quantum resistant. Before the whole quantum thing happens, it's already resistant.
It's already resisting. Well, it's because we built the technology, we build the curves, So I think quantum's very interesting. I think there's a lot of real in terms of real business utility, I think there's certainly is a lot potential there. From a crypto perspective, I'm not too concerned.
All right. Yeah. So I touched upon CoinCheck, but can you explain to me what happened there?
Yeah, sure. So I think it was January, maybe 26th or so of 2018. CoinCheck at the time was one of the largest exchanges, and they lost $535 million at the time in NEM blockchain, right? And if we think about let's break that down a little bit. What exactly happened there? So let's start off with the structure of any exchange, any centralized exchange, right? And a lot of people, who are not into crypto, they're like, oh, well, I have an account on the exchange. I have my funds on there. It's my money. And the first thing they learn is that actually it's not your money. You hand over your private keys to the exchange when you create an account.
If it's not fiat cash.
Correct. And those funds become commingled in wallets that are owned by the exchange specific to a particular coin. Okay, in this case, NEM, right? And that's in a hierarchy of wallets called HD wallets, hierarchical deterministic wallets. And there's a private key at the top, if you will, right? And so in the case of CoinCheck, you had social engineering occur on an administrator's laptop and basically clicked on the wrong link kind of thing, right? And next thing you know, the attacker was able to access, of the crypto. Now, I'll just take a pause here for a moment. We don't necessarily know exactly how that occurred, but there are many different attacks that could have occurred. One is a lot of these applications, these crypto exchanges are built using Docker technology, right, which is a containerized technology. And there are well-known exploits for Docker. One's called like a permission exploit, right? And basically the way this works is if someone socially engineers the credentials of, let's say, an administrator who's part of a group, and this group has essentially hard-coded authorizations to use a whole set of services, then if that attacker can fake being the administrator, they get access to the group. They run a specific command in Linux that gives them what's called root level access to the infrastructure that this is running on. That allows them to then navigate through and take over any kind of Docker application that's running on that system. So there could have been something like that done on CoinCheck. The bottom line is that the private key was obtained. And one of the things that people think about, well, when you got to protect the private key, you got to protect the private key. Well, actually, the most important thing is to prevent the private key from being misused. And in the case of CoinCheck, it was misused to sign one transaction that basically liquidated that wallet, right? And went out to, well, a lot of different, nefarious wallets, right? Yeah. And so, when we think back about like, well, then what did we learn? What's the post-mortem, if you will? The first, of course, you think about is, well, there wasn't really multi-signature, turned on. I mean, apparently NEM supported it at the time. But the users of the exchange and the exchange itself were not interested in using that, right? So basically means that, the exchange decides it wants to liquidate the wallet because, well, it does. The end user accounts have no say in that. We don't see that changing very much, right? Yeah. Then, of course, the whole idea of centralized wallets by coin with commingled assets. Well, that's basically how these different exchanges are built, right? So that's not going to change either. The only thing that you really can address is that private key and how you can protect and safeguard its use, right? And that's really where the focus, needs to be on, these exchanges like CoinCheck.
Yeah. But I guess it's also the same with Quadriga as well. And that's a little different.
A little different beast there.
A little beast there. But, I think over and over, all of these hacks is always about the private key.
Yeah.
And then how you actually, kind of custody even that as well, right? And
yeah. I mean, we just heard, I'm going to hope I get this right, LDAX in China, the CEO literally ran away with the cold storage, the keys, right? And everyone's just lost. It was an exit scam of an exchange, we think. I always have to qualify these things. Right?
Quadriga was the same.
Quadriga was the same. Is the owner really dead? I don't know. It's hard to say.
Easy to fake IDs and
and of course those funds all were really not in cold storage, were they? They had been
all
shipped,
hot wallets.
all on hot wallets of different exchanges, right?
Yeah. They all went to like Shapeshift, all these like exchanges that you would normally not send it to,
right?
Which is kind of weird.
And it gets back to the point of being able to safeguard the use of the private key in a way that's verifiable, right? It kind of gets back to this whole idea of these bespoke policies and things like that to prevent the insiders and the CEOs from acting poorly, right, with your funds.
Yeah. So I think you also spoke about sharding. Private keys, and this is like another very technical term that some people might not understand, but like sharding keys, like you split one private key into multiple pieces, so that you need a certain number of people to put them all together.
Yeah, and I guess it kind of so you learn like on these exchange hacks like CoinCheck. Okay, I got it. There's a private key, right? What can I do about that private key, right? So one technique would be to shard it or split it up, maybe multiple parts, right? And you can put those parts on different clouds if you want, or hold them in different places. But the thing about it is that you still need to bring those pieces together in order to sign a transaction, right? And again, we talked about that permission exploit. What happens if someone had run that owns the system that those keys are being reconstituted on? Well, it's essentially they're just waiting for you to bring a transaction, and they'll take the key. You can do your transaction, but now they have the key. So that means they'll do another transaction behind your back, right? And so Shammer Secret is good, but it's still not awesome because you still have to bring it back together to do a transaction. And what other things can you do, right? Another approach might be, okay, let's shard that key up and give it all different people a piece, and let's use what I call fancy math, and technically it's secure multi-party computation, to sign a transaction without actually physically bringing those key parts together. And each of those key parts, those shards, would be encrypted. Okay, and so this is a very innovative approach, and multi-party computation has been around for a long time, but it's never been able to be operationalized until really just even, I would say, this year. And there's a full credit to Unbound, which I think is truly the thought leader here. Curve as well, but they have put a lot out there in open source. They've got lots of thought leadership out there, and they've really perfected these kinds of techniques. And that allows Unbound and others like them to offer a different kind of protection against the use of that key. In this case, they can't use it maliciously. They have to follow the authorization and approval, process that has been laid out, right? And I think where these kinds of services will improve over time is that it's almost like an armadillo. You know what an armadillo is?
Yeah, of course.
Okay,
It's a hard top.
Hard top, right? Yes,
Yeah.
It's got a hard top, right? But it has a soft underbelly,
Yes,
yeah?
exactly.
So this fancy math is kind of like the hard top. It can work in a compromised environment and so forth, but the underbelly can't. The underbelly could be really mundane things like a key management database, right? That has the rules for how the keys are rotated, how they're managed, how they're governed. It could be things about governing user accounts. It could be logs, it could be the actual list of the approvers. So maybe you have these great orchestrated workflows for approving, but hey, if I can get access and I can change the approvers all to be me, it doesn't really help, right?
Yeah.
So a lot of this sort of like soft underbelly stuff, somewhat creates additional attack vectors that, a really good hacker could in fact start to think about subverting these kinds of even multi-party computation-based signing algorithms.
Yeah. So it's all about like reducing that soft belly and like increasing the hard top.
That's
right?
correct. More hard top.
Yeah. Curled up armadillo.
That's right. That's right. Yeah. I think, you kind of reminded me, in the trade-off between, ease of use and security, we mentioned key sharding. Well, we've talked about the different ways to do that, but there's also just different ways of doing it that don't necessarily involve sharding of keys, whether maintaining a full key. And that's done through hardware security modules, HSMs. Now, if I ask you, so what's an HSM? What do you think? How would you respond to that?
The sound sounds like it's some like box.
The box, okay.
Yeah, that has some kind of, a hardware device where you can, stick a USB or something, and then, you put your crypto in it or something.
Oh, God forbid. So HSM, let's go back to history a little bit, right? So in 1973, the data encryption standard was the first, if you will, open source public encryption standard. Do you know who actually created that and open sourced it? IBM did. Okay. Shortly after that, you had, hey, you know what? This could be really useful for banking and financial transactions. Let's build a piece of hardware that could take advantage of this encryption. So they created hardware security module. You know who created those?
IBM.
They're on a roll. Okay, so an HSM then it basically has a true random number generator with high, what they call entropy, and it creates a very good random number, which can then be used as a key. Okay, and then it has the ability to sign transactions, as well as look after keys, if you will, manage the keys. Okay, so among other things, depending on which HSM you're looking at. IBM has obviously been involved with HSMs quite a long time. Most of the financial system in this world, runs on these devices for keys and so forth. And in fact, if you have taken money out of a automated teller machine anytime recently, the PIN code that you type in, that goes into an HSM.
Yeah,
right. Okay, so companies said, hey, this hardware, security module thing, why don't we build applications inside of that, right? And the thinking here is we can balance the ease of use with the inherent security of a secure boundary in an HSM, which it is true, it is very secure, right? And so you've seen a lot of the major players out there building and deploying solutions into hardware security modules, which is a very interesting way of doing it. And I think there's some definite pluses and minuses to these approaches, right? The plus side is that you don't have side channel attacks, and you don't have what they call software crypto, which itself is, let's just say it's not as robust as actually signing inside of a piece of hardware. Okay, software will never be as secure an environment as hardware is. Okay, that's a true statement. On the same token, though, however, if you have to take the operating system and the firmware of a hardware security module and you have to repurpose it with your stuff, well, now you've created additional maintenance concerns, right? So I've got to maintain their stuff, I got to maintain mine stuff. I have this whole idea of authenticating transactions and users inside of an HSM. It's not really built for that kind of stuff, but you can do it. And then, of course, if you have different chains, like say Bitcoin, let's say segregated witness or whatever was taking off, I now have to follow those versus others. It has to be policy aware. And so all of these things create the need to have other HSMs as backups, because some of these might have to be down for maintenance, if you will.
Right.
Well, if you have backups and you have a network administrator, they certainly have the tools to watch the keys go between, the primary and the secondary, right? So that's something to think about. And obviously, just availability is something to think about, and scaling, right? As you go more and more, there's not a lot of room in these HSMs. Okay, so it's not like it's you can scale indefinitely.
All right. Are these like offline though? Right. I mean, HSMs are offline, like what you call a cold wallet, because there's so many temperatures around. So
yeah, lots of temperatures. Yeah. So yes, so you have HSMs that are cold, right? So like Gemini, their cold storage is using HSMs, all regionally distributed, geographically distributed. But other companies build warmish, if you will, wallets, meaning that they're not like hot wallets with protections. They actually afford lots of protections, right? And they're available on demand, if you will, because the assets are stored inside of the secure boundary of the HSM, and you have the business logic right next to it. The only issue with that is that when you have developers and other trusted, privileged individuals who have access to this environment, they in fact could do some pretty nefarious things. They could insert malware into, let's say, a wallet, and then that's deployed over time, could start to inject the malware or do passive, leakage of key material over time, and in fact get the key material out of the secure boundary. There are other cases where, pointed out by some companies, because the firmware updates are not done within the secure boundary, you could insert malware into the firmware, and big problems, right? So there are concerns with building these applications inside of things that you put your keys in, your PIN codes in, right? But it's certainly one way of addressing overarching concern here, which is how do you manage the safeguarding and the safe use of a private key?
Okay. Sounds pretty complicated. Yeah, cool. All right. Thanks, Peter.
Great. Thank you for having me.
Thank you very much, man.
All right, man. Cheers.
Hi, this is your host Takatoshi Shibayama. Thank you for listening all the way to the end. Now, if you enjoyed or disliked this show, please let me know by writing in the comment section. The only way I can improve or add value to you is through your voices. If there are any topics that you would like me to pick up, please also let me know in the comments. I'd love to start chatting with you all. And if you would like to continue watching the show, please subscribe. Thank you.